Hey there YouTube. So in this video I wanted to cover IRS forms 972 and 973. So form 972 is a consent of shareholder to include an amount in gross income. This is in reference to a C corporation distributing dividends to shareholders. Right, so there's a lot to unpack in this video. I'm going to start kind of with what this form is designed to accomplish, and then we'll flip back to an 1120 so I can show kind of how this example works. But bear with me, it can be a bit lengthy, but I promise you this will make sense by the end of it if you watch the whole video. So why does this form exist? Well, for those of you who are familiar with C Corp taxation, C corporations pay tax initially at the entity level based on their taxable income, and then the after-tax income can be distributed as a dividend to shareholders, which is then subject to a second layer of tax, right? The second layer of tax is incurred at the shareholder level. Now, with Form 972, in effect, what you are doing is you are saying that even if the corporation didn't actually distribute cash to the shareholder as a dividend, the shareholder is still recording a deemed dividend distribution on their tax return and paying tax on the income. So obviously, the first question asked is, well, why would a shareholder ever want to do that, right? Why would you ever want to record phantom income on your Form 1040? And in this example, what we're going to show is that this is quite often the case with personal holding companies. Okay, so a personal holding company is a C corporation that meets certain requirements and it's subject to more onerous taxes. So let me jump up to the 1120 here. This is the example I have in front of us. And I'll go through what is a personal holding company, how is it subject to tax, and why we might need the 972 and 973 forms. So personal holding company is a corporation that meets certain requirements, right? So generally it has 5 or fewer shareholders, and the company generates personal holding company income. So this is portfolio income, interest, dividends, rents, royalties, or it generates income from personal services contracts, okay? Personal service contracts. So in this example, what we've done is this corporation is set up, it's owned by one person, and this individual is an actor, right? So he is hired to perform acting roles for commercials, movies, whatever it is, but he wants to designate the payment to this corporation. Now, under the PHC rules, because he is the one that's performing the contracts as an individual, right? I mean, he can't just have his company sign a contract and then he can go out and hire anybody else, right? He has got to be the one that's doing the work, and that's specified in the contract. It's a personal service contract, and so thus we have PHC income in this entity. So this actor, he generated $200,000 in revenue. He has some expenses here. Here's his net taxable income in the corporation of $132,350. Now, why is this important when we talk about PHC income? Well, corporations are generally subject to a 21% tax rate on this net taxable income, but they're also subject to an additional PHC tax if it's a personal holding company. In this case, it is, right? And that's because the IRS doesn't want individuals kind of funneling money into corporations to try to defer tax. What they want is either you earn it individually, like just directly, or you generate this income and you distribute all the earnings out immediately and pay the taxes in the year that you earn the income. So if we look at a PHC schedule here, bear with me. So Schedule PH, this is attached when you have a U.S. personal holding company, right? So you have the PH tax computation here. And what this is designed to do is when you have undistributed PHC income, you pay an additional 20% surtax. So that's why when we look at the page 1 here, this $49,000 is certainly substantially higher than a standard 21% tax on the net taxable income. And that's because of the PHC tax. So And remember, so PHC taxes are imposed on undistributed accumulated earnings of the company. So whenever the company has undistributed earnings, right, in other words, they haven't distributed it as a dividend, they're subject to the PHC tax. So this is where the 972 form comes in. When you have somebody that is a shareholder in a PHC, they might not want to be hit with the PHC tax, but at the same time, they don't want to take the dividend distribution. So they want to leave the cash in the company to reinvest it for whatever purpose. So they're saying, look, you can keep the cash, don't give me the dividend, but I understand we're subject to the tax anyway, so I'll take the hit and I'll record the income on my return as if it's a deemed distribution. So that's the long and the short of it. That's where we're getting at here. John Q. Taxpayer, he's the shareholder of a PHC. He wants to try to minimize his PHC tax. And so he's saying, look, the company is not going to distribute any actual cash to me. It's going to keep it, but I'm going to take a deemed dividend distribution to try to reduce the PHC taxes at this Form 1120 level. So in order to do that, you've got to complete Form 972 and 973. So Form 972, this is the consent where the shareholder is saying, okay, I'm going to include this amount in income. I didn't actually get any cash for it, but I'm going to pay taxes on it anyway. Okay, so 972, we have the name of the shareholder here. This is John Q. Taxpayer. He owns 100% of the company. John Q. Taxpayer is saying that, look, I agree to include $25,000 in gross income on my return for the 2020 tax year, right? Tax year beginning 1/1/2020, ending 12/31/2020. And I'm going to treat it as a taxable dividend distribution to the shareholder of this company, right? This is the company I own, Personal Holding Company, Inc. And here we have the address for the company. Now in Schedule A here, we provide some additional information on what type of stock John owns. He owns common stock, 1,000 shares, right? 1,000 shares are issued and outstanding. He owns 100% of them. Certificate numbers, this is the QSIT number. You know, if it was a publicly traded company here, that doesn't apply. It's just a privately held company. It's not registered anywhere. And then the amount of consent distribution that's allocable to this class of stock. So we have 1,000 shares of common stock outstanding, no preferred stock, no Class B, C, D, or other kind of shares. And the $25,000 is the amount of the deemed distribution, so the consent distribution that's being allocated to John. And then John is required to sign this, put his title down and date it. And the 972 form is going to be attached to the Form 1120 for the year. Now, in addition to the 972 form, the corporation itself needs to complete Form 973. So this is the corporation's claim for a deduction for those consent dividends. And this has to do with the accumulated earnings. So if I flip back up here really quickly, this is the balance sheet for the company. The company had $132,000 of income. So that was their retained earnings at the end of the year before considering a deemed distribution. So we have $132,000 in net income per books. That's the retained earnings, unappropriated. And then we're having a deemed distribution of cash, $25,000. Reduces the retained earnings to $107,350. So that's the $107,350 here. That's really, really important. So normally the retained earnings is only reduced if you actually distribute out cash dividends. Remember, we're not actually distributing the dividend, so the cash account here isn't going to be constructively reduced, right? That remains the same. We're just having a deemed distribution of cash for $25K, so that reduces the retained earnings unappropriated 107. And in order to make it balanced, you just flip the $25,000 up to APIC or some other adjustment to shareholder equity, just to let the evidence on the books that there was a deemed distribution of retained earnings. The cash just wasn't actually shelled out. So then if we flip back to Form 973 here, we have, The company is the Personal Holding Corporation, Inc., right? The name of the company, the tax year, EIN, the type of stock where we're having this deemed deduction for consent dividends, the number of shares, beginning of the year, end of the year, the type of dividend rights. Again, this is just common stock, so we have a common stock shareholder. If you did actually make distributions during the year, you would include it here. So, you know, if your total dividend deduction from retained earnings is, let's say, 40,000, 25,000 was deemed, and 15,000 was actually shelled out, you would put the 15,000 number here. But in this case, we didn't actually distribute any cash dividend distributions during the year, so we're leaving that blank. And then at the bottom here, oh, sorry, there is nothing else to complete here. It doesn't have to be signed because, again, this goes along with the Form 1120. So this is just an attachment to and made part of that Form 1120 return. Where else do you see the $25,000 distribution? It's on the Schedule PH. So the personal holding company tax computation, we have the deduction for dividends paid. The 25,000, and again, this is evidenced down here in Part 6, right? So the deduction for dividends paid as a reduction for retained earnings unappropriated. Taxable dividends paid, these would be the dividends that were actually paid out during the year. So if you constructively pay out, again, if we use our $15,000 example, if you paid out 15 grand in dividends, you would report that here. And then you had the consent dividends. These are the dividends that weren't actually paid out, but the shareholder is agreeing to record these dividends on their tax return and pay taxes even though they got no cash. And so you would attach, as it's noting here, attach forms 972 and 973 to support this deduction. And then the total, right? The total taxable distributions are 1 and 2 combined. In this case, we just have $25K. Now, so for the shareholder, what do they do with this $25,000? The shareholder here, John Q. Taxpayer, when he does his Form 1040, he needs to report $25,000 as dividend income. So on his Schedule B, where he indicates interest income and then dividend income, he's going to have a line item for $25,000 of dividend income from Personal Holding Company, Inc. Right? That's very important, right? In order to be able to claim the deduction at the corporate level for the dividend distribution, John has to include this amount in his dividend income on his annual tax return, right? So on his Schedule B of his Form 1040, he's going to include this amount, and he'll pay tax on it even though he got no cash. But again, because it's a personal holding company, oftentimes it makes sense for the taxpayer to do this anyway. So that covers it. I hope that was helpful. If you have any questions, please leave me a comment below on the video. Happy to help wherever I can, and I hope to see you again soon. Thank you.